Hey there, it's Gretchen Coley with the Coley Group at Allen Tate, and with all the volatility in the stock market and the uncertainty about COVID-19, some people are concerned that we may be headed for another housing crash like the one we experienced in 2006 to 2008. This feeling is totally understandable. I mean, people still have PTSD from the last market crash. And the biggest fear I have seen is that people are afraid of buying a home at the wrong time or the wrong price. And I wanted to share some thoughts and data with you that will help ease that fear, because this is a great opportunity to buy a home and take advantage of historically low interest rates. When we look at data to help us understand where the real estate market is, there are 5 different economic factors in the market that show us what we're going through right now is nothing like what happened in 2008. Number 1, mortgage standards are not like they were leading up to the crash. It was not difficult to get a mortgage during the housing bubble. Today, it is tough to qualify. Take a look at the graph on the screen. This is the Mortgage Credit Availability Index from the Mortgage Bankers Association. It's a summary measure which indicates the availability of mortgage credit at a point in time. The higher the index, the easier it is to get a mortgage. And you can see that during the housing bubble, the index skyrocketed. We are seeing the mortgage index under 200 right now, which is a great place to be. Number 2, home prices are not soaring out of control. Just take a look at this graph showing annual house appreciation over the past 6 years, compared to the 6 years leading up to the height of the housing bubble. Even though price appreciation has been strong recently, it is nowhere near the rise in prices that preceded the crash. Normal home appreciation is about 3.6% in the Raleigh market, and that is right in line. We have a shortage of homes is number 3. We need 6 months of inventory to sustain the real estate market. More than 6 months of inventory becomes a buyer's market and causes prices to depreciate. Less than 6 months is a shortage and will lead to continued appreciation. The graph you are seeing shows there were way too many homes for sale in 2007, and that caused prices to tumble. Today, there's a shortage of inventory, which is causing home values to increase. In the Raleigh market, our inventory of homes is less than 3 months. That's far from the 6-month average. Number 4, houses became too expensive to buy. Take a look at the graph that shows the median income. There's a formula called the Affordability formula that shows how affordable a home is. It has 3 different components: the price of the home, the wages earned by the purchaser, and the mortgage rate available at that point in time. 14 years ago, prices were high, wages were low, and mortgage rates were over 6%. Today, prices are still high, wages, however, have increased, and the mortgage rate is about 3.5%. That means your family pays less of their monthly income towards their mortgage payment than they did back then. Number 5, people are equity rich, not tapped out. In the run-up to the housing bubble, a lot of homeowners were using their homes as a personal ATM machine, and that is bad news. It was common for a homeowner to withdraw their equity once it built up through a refinance or a HELOC. And boy, did they learn a lesson in that process. Prices have risen nicely over the last few years, leading up to over 50% of homes in the country having a greater than 50% equity. That's huge. But owners haven't been tapping into that equity like they did last time. The image on the screen shows the equity withdrawal over the last 3 years compared to 2005, 6, and 7. Overall, homeowners have cashed out over $500 billion less than before. During the crash, home values began to fall and sellers found themselves in a negative equity situation where the amount of the mortgage they owed was greater than the value of the home. Some people decided to walk away from their homes, and that led to a rash of distressed property listings. Just think foreclosures and short sales, which sold at huge discounts. This lowered the value of other homes in the area. Based on these numbers, we don't see that happening today. So I hope this video answered some of the swirling questions that may be in your mind, and I hope you found it helpful and valuable. It was helpful for me to take a look at all of this in black and white as the questions started to come into me. So if you have questions, we have answers. We would love to have a conversation. Give us a call at 919-526-0401.